Hello and welcome to a fresh new edition of Taking Stock. This is the show where we look back at what has happened through the course of this week, and boy, did a lot happen. But more importantly, the purpose of the next 30 minutes is going to be to look forward and in a way prepare you for what is likely to happen, what is coming our way in the next 5 trading sessions. So I'm Prashant Nair. With me, my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Yes, what a week it's been. And a week that has seen some positivity return back to the street. There's no taking away. You know, in one line, I think this is a market that's now trying its way up back to the 10,700 mark. That was the hallmark. Just very quickly drilling down through some of the factors. Now, some of the key takeaways from trade this week are, number one, there is a return of positive sentiment, and you've got to entirely thank the collapse in crude oil prices for that. And maybe to an extent, the fact that there is hope that there is thaw between Finance Ministry and the Reserve Bank of India, and we won't see a blowout situation. So those twin factors really propelled the market higher. The Nifty, as I said, it has been taking aim at 10,700. But this is the tricky part, because here is where technical analysts will tell you it's running into certain key resistance levels. The other, worry point of this week was, despite the 1% rally on the index, is the underperformance in the mid-caps. This is a rally that has been led largely by big stocks. We're talking about banking names, HDFC Twins, Reliance. These are the kind of stocks that have done really well. The mid-cap index is actually down slightly for the week. Financials made a roaring comeback, so that's again a thumbs up point. But if you drill it further down and talk about some of the movers and shakers, then interesting names really come up. I mean, guess what? If you're talking about some of the biggest winners for the week on the Nifty, then Bharti Airtel is actually topping that list with a massive move on Friday itself. Titan saw some buying, so some believers coming back after the second quarter performance. And BPCL, of course, it was a beneficiary with the way the oil prices collapsed. On the losing side, again, some event-driven stocks or result-driven stocks where the cuts have been deep. So Yes Bank, for instance, down almost 10% for the week. Sun Pharma was a negative results reaction. Indiabulls Housing Finance is interesting because towards Friday, this whole part of the market was once again a question mark. Housing finance companies, because despite good reports from the credit markets that rollovers are happening, housing finance stocks still had some problems. The other two that stood out for me, Prashant, were the likes of a Motherson Sumi and Ashok Leyland, telling you that if there is any disappointment with the companies with respect to earnings or any other corporate event, then perhaps room for error is really limited.
Oh, absolutely, Surabhi. And I mean, you're right, because the index itself was up about 0.8% on the Nifty. But some of these stocks that you mentioned went up and down some 10-15%, right? I mean, so it really was a week as far as stocks go. I mean, that's the change that we're talking about. Nifty, Bank Nifty higher. The small cap index was actually down for the week. And I think the mid-cap index also, the BSE's mid-cap index was actually also lower for the week. So that underperformance was stark. Okay, so where do we go from here? And I'm just going to highlight 4 or 5 points. The first big one is oil prices. So if you're sort of looking for incremental help from oil prices, probably that is not coming. It seems like the big drop in oil prices is done for now. I mean, actually, from the lows, WTI, for example, is already up about $2.5 odd. The recent lows, I mean, so the lows seem to be in. Don't expect further help by falling oil prices. I mean, you can sort of look at data of net long positions in oil markets, etc., which has declined dramatically, and you can safely arrive at that conclusion. I mean, $20, the oil prices have fallen. I don't think anybody's expecting a continuation of the kind of fall that we've seen. Of course, there is risk on the upside. But again, I mean, the general sense in the market is that maybe oil prices stay sideways and maybe probably behave themselves without, shooting higher. To my mind, the trouble spot is U.S. markets. And I highlighted this earlier as well. All big indices, be the Dow, the S&P 500, etc., they're all exhibiting signs what we saw in February, March of 2018, earlier this year. I mean, that was a time when markets cracked. I mean, the first decent crack in many, many months. And then there was a very sharp pullback, almost getting back to the 76% retracement levels. And then there was another retest of the initial lows. It seems like so far, unless, of course, we see something different later, that same pattern is being followed. So it doesn't look like we are out of the woods as far as US is concerned. Equity indices are concerned, and that is the big mother market. So S&P starts to sell off. No amount of positivity here is really going to make you rally. I mean, you might not fall that much, but that is important. Brexit uncertainty is still top of mind. So far, it hasn't really, except maybe the the pound-dollar cross, or maybe it's showing up in currency crosses. It hasn't shown up around the world in any significant way. Could that? Well, surely yes. Brexit, when it first happened, was a big deal. I mean, it did roil markets around the world. The current deal in this form seems to be absolutely dead. What we are now talking about is whether the government itself may survive or not. We don't know the answer, so that uncertainty is still there. And at some point, these things suddenly become a big issue for the market. So far, as I said, it hasn't. And on Monday, as Surabhi also earlier pointed out, there is that meeting between the RBI, the RBI board meeting, and it's going to be a contentious one. All signals indicating that, things have simmered down quite a bit and they're not on the boil anymore. But I think it's going to be important for debt markets, rupee markets, and of course, equity markets as well. Surabhi.
All right, so we have plenty to take stock of. Let's start with the global cues and dive a little deeper in some of the trends that we just highlighted. We have with us Yan Den of the Ashmore Group. Yan, thank you so much for taking this call. It's been very interesting because the Dow is still doing its thing. We still get these odd 500-point drop sort of days. First of all, what is your sense on the U.S. market and the way it's been volatile now?
Yeah, I think the key innovation in the U.S. market is that for the first time since the rally began, about 400% ago, shortly after the financial crisis, for the first time we're beginning to see cost pressures for American companies beginning to eat into earnings. This is not a trivial matter. Cost pressures are coming from a number of different areas. First of all, we're close to full employment. Wage pressures are going up. Secondly, the dollar is very expensive. Thirdly, the Fed is hiking rates. And perhaps at the margin, most importantly, the U.S. government is imposing tariffs, which directly raises costs for inputs such as steel and aluminum, but also makes it more difficult or expensive to outsource production to cheaper places around the world. And that forces production to be done back home where there's already full employment, and so you end up getting higher costs. So there's no indication, as far as I can see, that these cost pressures are going to abate over the next couple of years. And so we have a real issue here because productivity in the United States economy is not going up. In fact, the last quarter, it declined. So we have a situation here where, looking forward, it's difficult to see where there's going to be a lot of upside coming from for the U.S. stock market.
So do you have a directional call, Yan, on U.S. indices?
My expectation is that the U.S. stock markets are going to slow down and we're going to start seeing a progressively more tepid performance. I think it's going to take a significant macroeconomic shock to push us into, an outright strong directional move either up or down. The two things that could really move us in a very, very severe way up or down would be either that we, and this is not my expectation, but we have to consider the possibility, we get a productivity miracle of some sort that suddenly elevates the U.S. economy to sort of a 5% sustainable growth rate. I don't think that's likely. The more likely scenario is that at some point we get a macroeconomic shock that pushes us into recession. And that could actually be a further escalation in trade tariffs if, for example, the U.S. adopts the 25% tariff level come up in January. If that happens, then you're going to really start seeing American companies facing serious cost problems, and that could then trigger a serious directional downward move in the U.S. equity market.
Okay, so the U.S. equity market seems to be a risk then for even us here in India. What about Europe, Yan? That's the next piece of the puzzle, right? What is going on with this Brexit and how should we interpret this? I mean, in case it comes down to another vote itself, is that good for markets, bad for markets? How do you expect equities to behave?
Yeah, there are three basic scenarios. The deal that we have on the table right now, the deal that Theresa May has presented, is a trade-off where she says, look, I'm going to do everything I can within this deal to minimize the negative effect on the UK economy, but in exchange, I stay in the customs union, but in exchange for that, I'll basically, on a transitory basis, give up political influence in Europe. And of course, that is exactly the opposite of what people voted for, and so that's why her political position is very precarious. But it is nevertheless the most beneficial, or should we say, least bad option for the UK in terms of economic performance. If she is rejected, fails, then we are probably going to have a much more hard Brexit government, which will lead the UK economy into a genuine economic disaster sometime in March next year, when we fall out of the European Union, lose access to 70% of our external trade markets without anything to replace them. That's a really, really negative scenario. So now, of course, it's possible that a government that takes us in that direction ultimately loses power, and then we get a fresh election. But then we have the Labour Party, which is going to pursue similar policies. So, that is a very challenging situation for anybody looking at the UK market right now. If Theresa May doesn't survive, well, then we're staring hard Brexit. The only way out of this, I think, is if we have the moderates across the political spectrum in Parliament coming together, forming a majority and saying, look, let's put this question back to the people. Let's pass a bill that allows us to have another referendum, basically asking people, do you really want to leave the EU or not? But so far, there is not any indication that such a sort of a coalition of national unity, if you wish, has come together yet. So at the moment, we are sort of on a precarious path heading towards a disaster. And I think this risk is underpriced. I think it's really quite a serious risk. It's because so much of Europe's finances are managed out of London. So, if we really do go over the Brexit cliff, I think it's going to be very serious for global risk appetite.
Jan, thanks indeed for joining in, and good speaking with you. Have a good weekend, and we're going to see you later next week. Appreciate your time here. Well, so that is the global perspective, and Jan Dan making it very clear that it's the Brexit remains a big risk, maybe unappreciated, but at some point it starts to sort of show itself up in a big way. Potentially. We have a local perspective now. Motilal Oswal, AMC's Gautam Sinha Roy is joining in. He's with us on the show. Gautam, thank you very much for the time. Appreciate it. Just a brief sort of view on where we are as far as the market goes, Gautam. There has been almost a 700-point rally on the Nifty from the lows. For now, I mean, is this pullback, according to you, done, or are there legs to this rally?
Difficult to say, honestly. Very liquidity driven. We have seen that domestic flows have continued to be very strong, and that essentially means that this is a market where all weaknesses are getting bought into. Weaknesses come when FIs sell and domestics keep on buying. So October was a classic month where FIs sold probably more than $3.5 billion. And that gave you a very good opportunity to buy into markets. So I think one has to be, if one wants really supernormal returns from these markets, one has to be patient and wait for those dips to come in, and those dips typically come in when FIs are selling very strongly. Now markets are more normative in terms of their valuation, so you should expect decent returns if you're holding for a 3-5 year horizon, but not supernormal returns. So I would advise investors to remain invested, but this doesn't remain that market where you should, be very excited and, buy a lot more of. So maintain your allocation, keep doing your SIPs, and that's about it.
Okay, keep sipping. That's the takeaway. Gautam, good evening. Now, the correction has also thrown up quite a few pockets of interest. Autos, for instance, I mean, the stocks are off quite a bit. Something like Ashok Leyland struggling at 52-week lows. We've seen, Motherson Sumi react sharply to numbers as well. Which are these pockets which find some interest as far as your funds go?
Yeah. So, last quarter, this was a festive quarter, right? And we had seen a very unusual demand environment for consumer discretionary, especially for autos, I would think, where we had seen sharp slowdown in demand for both the two-wheelers as well as four-wheelers, passenger vehicles. Now that really hammered the stocks down, the leading stocks. They were a bit expensive too, but for a long-term investor, that also created an opportunity to get into these stocks. These stocks remain cheaper, quite cheaper than their life highs, and even now I don't think the expectations of a demand revival are very strongly getting built in. So yes, that opportunity is there. On the export side also, there are only very few stocks there, auto comp exporters, but yeah, you're right, some weakness there. That's more to do with individual stock issues, whatever is happening in Europe and the trade wars. So that might take more time to get resolved. But if you are believers in the domestic consumption story, that discretionary consumption will continue to grow in the long term, then yeah, you got a fair opportunity in the month of October to buy into these stocks, and you can't complain about that. That's quite a decent correction is what you had got, and the stocks continue to remain inexpensive even now.
Okay, so inexpensive even right now. Gautam, the week gone by was billed to be this big one for NBFCs rolling over commercial paper and all of that, right? I mean, it passed without any incident. But if you look at it towards the close of the week, NBFCs have started to come under some pressure once again. So is it essentially a result of stocks having pulled back quite a bit already, especially from the housing finance sort of space? Or is it realization that although things are okay and nobody's defaulted, but further lending, growth rates, etc., are a question mark still?
Yeah, I think the biggest thing that should be changing as a result of whatever has happened on the NBFC side is that the pricing of risk, which had become very aggressive because of easy availability of money on the liability side for many of these NBFCs, that has to correct back to a more normative level. And if that happens, obviously demand for credit could also slow down. Some of the over-leveraged entities could also suffer. One keeps hearing anecdotal stuff about over-leverage with builders. Demand has been slow for a while. There is quite a bit of supply, especially in pockets where demand-supply mismatch is very, very prominent. So in that environment, yes, a worry remains on the asset side, especially if funds are not available very easily. Then and asset side problems start creeping in, then what happens for some of the builders, what happens for lenders to them, that concern definitely remains. The liability side issues that were the big concern of the market, they are getting sorted out. They have been managed well by the entire ecosystem so far. There has not been a major blowout, and we should be thankful about that. But yeah, this brings back to the fore the asset side concerns, which were getting hidden because the liability side picture was so rosy, right? So that is more of a structural story that should be of interest and bother to investors, especially in housing finance or companies which are doing LAP and all that.
So, Gautam, I was noticing something interesting. I think in most of the funds, under your universe, stocks like HDFC Bank find a lot of prominence. I think I even spotted IndusInd Bank in one of the funds. What is missing in the top 10 at least holdings are the likes of Axis Bank or SBI or ICICI Bank, which is where the excitement seems to have shifted now after the second quarter numbers. Would you be willing to buy corporate banks at the moment?
No, we do own a bit of the so-called corporate banks too, so to be, but you have to realize that after years of the corporate book being hammered down in these banks, and they have not been doing a lot of corporate lending, are they really corporate banks even now? Should they be called corporate banks? The legacy is of a corporate bank, but the incremental lending they have been doing in the last few years has been more retail in character. So in terms of differentiation between corporate and retail banks, what we classically have known and believed in, that from a constitution of the current book perspective, that might not materially be that right? I'm not saying that it's completely gone away, but the mix of corporate and retail is much more balanced. So all banks are corporate banks, all banks are retail banks. So you essentially have to forget that classification today. You have to see what segments are individual banks in, what are the profitability levels of these banks, how aggressive, not aggressive are they, what are the risk management practices, what are the valuation levels like. So all those things amalgamated should give you a picture about where these stocks are likely. But we do believe that large banks with a very strong CASA franchise have a clear advantage in this economy as long as credit growth is strong. Credit growth has been especially strong from the personal households, unsecured and mortgage side. I think on the corporate lending side also things are picking up a bit, right, especially on the working capital side. So yes, growth should be good. People who can fund the asset side growth through low-cost liabilities, they would have a clear advantage, and that is where our interests lie clearly, right? Strong liability side and not so checkered history on the asset side. That's what we are looking for.
All right, Gautam, thank you very much for your time. Appreciate you joining in here on this edition of Taking Stock. Have a good weekend, and we will speak with you soon again. We take a very quick break here on the show, and we are right back. But as we go into that break, we leave you with some market opinion that we got through the course of the week. Listen in, we are back with a technical check. Ashwini Gujral will be joining in with some trading ideas on the other side.
I've become a little bit more positive over the past month as markets have kind of reacted to to some of the things that we've been worried about for a long time, and quite a number of those are reversed now. I think the kind of thing that's on my mind is what's happening with China and the US, and interestingly, if that trade war continues, it means that India stands out as a defensive market in a global trade war, because we're a domestic-driven economy.
We're getting mixed signals, while the mood around the liquidity in non-bank financials is not as bad as it was a month back, but still worrisome amongst investors. Crude is a big silver lining which has helped revive positive sentiment somewhat for Indian investors. But I think the most global as well as local investors are also now looking forward to what happens in December 11th when the 3 state elections come out. I think the mood seems to be constructive on India.
Heard from a global sort of person on how globally set up is looking like now. You heard from a local mutual fund manager, and now we get you the view from Ashwini Gujral on the charts. How is he thinking of the market now? Ashwini, thank you very much for joining in. I mean, late on Friday, we did see that pullback, sharp pullback. Do you make much of it? Or would you say that after this sharp pullback from the lows, the risk reward isn't really favorable?
Well, today, by the end, the market turned fairly choppy. Now, the issue here is that you have huge overhead resistance, both on the Nifty, which is around 10,750, 800. Also on the Bank Nifty, there is some sort of congestion which is coming out in around 26, 500 thereabouts. So basically the pullback is now getting done. Now, fresh buying for the market to give you a clear follow. In the absence of that, the way to trade this weak uptrend is that you wait for some sort of a decline and then try to enter. So if the Nifty has, say, a 100-point type decline, 10,050, 570, Bank Nifty has declined to 2550. If you buy there, you get some support of the short positions covering, etc. But to buy at a flat situation or a gap up means that follow through will be difficult to come by. Now the next 150 points on Nifty are very crucial. Either we cross them and gain steam, or we reverse here. So very make or break type situation here, and it all depends how global cues etc. play out. But you should treat it more like a sideways market than a big uptrend.
Okay, what about the way global markets are moving? Ashwini, do you think that's going to have any bearing? Will that determine the course next week?
Naturally, because domestically the triggers are elections, which are probably some time away. We have to see whether global markets really do recover. If they don't recover and S&P goes down even further, then we are also poised at a turning point. So the idea is that while you don't immediately go short, but basically buy the dip and sell the rip kind of market.
Okay, Ashwini, in terms of specific trades, what would you recommend?
See, Motherson Sumi has reversed about 5-6% from the lows. So those are the kind of stocks you go long on. That's a buy with a stop of 145, target of 161. Reliance Infra is a sell with a stop of 334, target of 310. And DHFL is a sell with a stop of 235, target of 215. The other big issue is that mid caps are not catching up even after a 600-point Nifty rally. The mid caps are still kind of dithering, and today you saw all of these NBFCs etc. reversing again. So it's not clear blue skies yet.
All right, Ashwini, let's see. Yeah, it's not clear blue skies. Let's see what kind of a color of a sky we get on Monday morning. But for now, enjoy your weekend. We wish the same to the viewers as well. And Prashant, I think it's time for us to head out for the weekend as well.
Oh, yeah, absolutely. Long overdue. Thank you very much for staying with us. See you next week.